You find a setup online that looks incredibly profitable. You load your brokerage account, place your capital on the line, and wait for the wins to roll in. But without proving the strategy first, that foundation is entirely fragile. 3 consecutive losses hit. The confidence vanishes. You start tweaking indicators mid-session, widening stop losses, and reacting to every tick of the chart as your account bleeds. Professional trading relies on a statistical edge, a measurable, proven probability that a specific setup will generate more profit than loss over hundreds of occurrences. Throwing money into the live market without historical proof means you are relying entirely on hope. You are placing bets at a casino, not running a business. Backtesting software solves this problem by letting you run your exact entry and exit rules through years of historical market data. It strips away the guesswork and answers a simple question. If you had traded this exact setup every single time it appeared over the past few years, would you have actually made money? For discretionary day traders and futures traders, and anyone trying to pass a strict prop firm evaluation, this tool is mandatory. Seeing those thousands of data points shifts your mindset. You stop hoping a trade will work and start knowing exactly how the math plays out over time. There are 2 ways to build this data. Manual backtesting involves stepping through historical charts bar by bar, analyzing the price action, and visually placing simulated trades. This is crucial if you are a discretionary trader. If your decisions depend on reading the context of the market, like identifying support levels or volume trends, you need to train your eyes to see those patterns unfold in real time. Automated backtesting, on the other hand, instantly processes formalized algorithmic rules across decades of data to plot your long-term equity curve. Whether you are training your own intuition or writing machine code, the goal is identical. You are formalizing strict rules of engagement so you know exactly when to enter and exit. But generating a final net profit number is not enough. You have to verify the specific performance metrics hidden inside that result. This chart visualizes maximum drawdown. It measures the absolute largest peak-to-trough decline your account equity suffers before recovering. If your strategy has a 50% historical drawdown, you need to know if you can actually stomach losing half your money before the system bounces back. You also have to measure your win rate against your risk-to-reward ratio. Winning 80% of your trades means nothing if your average loss wipes out 10 average wins. Then there are the statistical illusions. Look-ahead bias occurs when you inadvertently cherry-pick perfect historical setups because you subconsciously remember how the chart played out later that day. You must also account for market friction, the hidden brokerage fees, bid-ask spreads, and sudden slippage. The difference between your expected execution price and the actual fill will severely drain a strategy that trades frequently. This is how you end up with a strategy that boasts a flawless 70% win rate in a controlled backtest, but completely liquidates a live account in a week. There is one variable that historical data can never simulate: the person pressing the buttons. When real money is at risk, cognitive overload sets in. Fear causes you to sell your position early. Hesitation makes you miss the optimal entry. Anger leads to revenge trading that ignores your rules entirely. Backtesting proves that the mathematical strategy works. Live trading proves whether the operator actually has the discipline to execute it, and when market volatility spikes, human discipline shatters long before the mathematical models do. Even top-tier institutions recognize this. This document outlines institutional risk management strategies during major market crises. Notice how heavily they rely on formalized protocols and hard thresholds, rather than trusting a floor trader's intuition when the market is crashing. A perfectly backtested strategy holds absolutely zero value if you don't have a reliable system to enforce your behavior in the moment. To bridge the gap between theory and live reality, you need a performance platform like TradeZella. This visualization shows the divide. By logging your live trades next to your backtested data, you can see exactly when and where your live execution deviates from your proven model, tracking the specific emotional states that lead to losses. When live results fail to match projections, use TradeZella's Trade Replay diagnostic tool. It reconstructs actual executions tick by tick. Watch the chart move exactly as it did, exposing the exact second you hesitated or panic sold a position before hitting your target. Validate your edge in the backtester. Execute in the live market. Replay the session to catch mistakes and refine the rules. This continuous loop is how you force your human execution to match your mathematical edge. Backtesting builds your edge. Comprehensive journaling and review preserve it. Stop guessing with your capital. Click the link below for 20% off TradeZella and start operating a data-driven trading business today.